Hey guys, what's up? Hope you're all doing well. So today I'm back with another video about investing in the stock market. To be honest, I'm really loving this sort of segment on my channel. So if you see a bit of, excitement and stuff, yeah, that's why. So in previous videos, I've spoken about why you need to get started with investing in the stock market if you haven't already. I've also spoken to you about the first 3 stocks that I bought back in May, and I've sort of told you the platform that I use and things like that. But today we're going to take it right back to basics. So everything that you need to know essentially before you start to invest. Okay, so without further ado, the first thing that you need to do is make sure that you have an emergency fund. So what is an emergency fund? Essentially, this is like your rainy day money. This is a savings pot for emergencies. So let's say there's a medical emergency that you didn't expect to happen, or maybe a loss of employment, or sort of things like that. Basically, car repairs, that's where that money goes. It's an emergency fund, so for emergencies essentially. Right, so your emergency fund should basically cover at least 3 months worth of expenses. Nowadays it's best to sort of aim for 6 months worth of expenses, but if you can only do 3, that's still a good starting point. Obviously the more the better. So how do you practically go about setting up your emergency fund? Well, basically you just need to identify what your expenses are, for a 3 to 6 month period, and then work towards saving for that. Now, to help you with this element of saving for your emergency fund, I do actually have a budget tracker, if you didn't know. So my budget tracker essentially has different segments for all types of expenses. So your essentials, your bills, mortgage, rent, all those kind of things, as well as sort of the things that you want to buy, or sort of your more luxury spends, as well as a section for debt management. So if you don't already have a budget tracker, mine is linked in the description box, so you can grab that if you want to. The second thing that you need to do is open up a stocks and shares ISA or an investment ISA. They're basically the same thing. Now, a lot of people start off their investing journey by opening up one of these ISAs because it is really tax efficient. So you have your £20,000 tax-free allowance for an ISA. Basically, if you invest in a stocks and shares ISA, basically you get to use this allowance and you don't pay any income tax or capital gains tax on money that you invest through that ISA, and also any sort of capital appreciation or gains that you make also do not go through this tax. As the name of the product suggests, you're basically investing your money in a variety of different stocks, shares, investment funds, bonds and things like that. So that is how you're able to get a better return on the money that you put in that account versus maybe the interest that you're getting via the bank. As I mentioned in the previous video that I'll just link in the cards, I told you how basically I have my investment ISA set up with St. James Place, and since opening mine in last July, mine's already seen a 12% return, which is really good compared to the 0.1% that I'm seeing from my savings in my bank account. The third thing that you need to do is decide on the platform that you're going to use to trade, to buy your stocks, manage your portfolio, etc. So the common ones in the UK are Vanguard, Hargreaves Lansdown, you've got Trading 212, and you've got Freetrade, which is the one that I've opted to start with. When trying to make your choice in terms of the platform that you choose, you need to ask yourself some questions like, are you happy to pay fees for making trades? So are you essentially happy to pay fees each and every time you buy and you sell your stocks? At this stage, I personally didn't want to pay any fees, which is why I went down the route of going with Freetrade. Also because they had all the kind of stocks that I wanted to buy. And whilst on the topic of free, if you haven't yet started your investment journey, or maybe you have but you're not using Freetrade, I do have a link in the description box that basically enables you to get a free share through Freetrade. So you definitely want to do that. As I've already made reference to, are the companies that you want to invest in available on the platform of choice? That's another key consideration. And finally, in choosing a platform, does it support you in age or learning? So again, I really like the fact that with Freetrade, it really supports kind of my analysis and understanding of companies, and basically helps me to make better decisions when stock picking. And they have daily newsletters that they send out, which is really good. And I think especially as a beginner investor, it's really good to have all these kind of resources at your fingertips, because I know personally I'm not the kind of person that likes to stay on top of the news like that. It's really not my bag. And so yeah, it's nice to have relevant news articles sent to you via email, which is what I really like about Freetrade. I'm sure a lot of these other platforms have that also, but that is something to look out for, especially as a beginner. Now, step 4 of beginning your investment journey is essentially to manage your risk and basically diversify. So what do I mean? Start by investing in funds. It's always advised that newer investors start by investing in index funds and ETFs. Now, index funds and ETFs basically allow you to invest in a variety of different companies rather than, buying one individual stock. So let's take, for example, the FTSE 100 and the S&P 500, which are basically ETFs that track, the top performing companies within the UK and also in the US. So it's a really good idea to invest in ETFs and sort of index funds like this because, again, you're managing your risk, you're spreading, the money that you've invested among all these different companies. And so even if one or a few of the companies aren't doing so well, at least it's balanced out by the fact that, you've also got money invested in other companies that may be doing a lot better. Another reason why it's advised to take this step in terms of investing in these funds first is because, when you're new to investing in the stock market, likelihood is you won't know a lot, or you just don't have the sort of patience or willingness to do the actual analysis required to pick good individual stocks. And so yeah, that's why people advise to stay clear. However, I did not actually go through that conventional route. I did not start off by investing in an index fund or an ETF. I went straight into individual stocks. So why did I personally go that route? It was literally because I actually have an interest in learning about the stock market, learning how to pick my own stocks. I like the part of, doing that analysis and sort of I think it's quite exciting, to be honest, the ability to be able to look into a company a little bit more, look at their balance sheets, not going too deep in, but just even on a surface level, I find it quite interesting. And I feel if I'm investing in this area, I do want to have a decent understanding of what exactly it is and why I'm doing so. So yeah, for me, that's why I went straight into individual stocks. And also I felt I could really see some really good top performers that I felt I had to get my hands on. So yeah, that's why I started that route first. So what exactly is the difference between ETFs and index funds? Because I think some people do use the terms interchangeably just because, they're both funds. But the difference is basically that with ETFs, you can trade them throughout the day normal individual stocks. Whereas with index funds, you literally can only buy and sell them at the end of a trading day. So there's more restrictions in that sense, and you can only buy and sell for one price. And now finally, step 5. So now that you've invested in, your funds, whether it's an ETF or an index fund, which I have, by the way, now, now it's time to basically have a little fun and start challenging yourself if you want to, that is. So you can start to invest in individual stocks. Okay, so now when going down the route of individual stocks, you first and foremost, you need to identify what your goals are, with anything. So with property also, you need to know what your goals are and then follow through with picking stocks that, will enable you to achieve those goals. So number 1, if your goal is regular income, then you're going to want to invest in companies that pay out a dividend. So essentially, you want to buy stocks and companies that will give you a regular payout. So the payout could be annually, it could be, quarterly, it could be twice a year, it could be monthly, some are more regular payouts. But yeah, you just want to look out for companies that will pay you a dividend. 2, if your goal is wealth preservation, then you basically want to invest in blue chip companies that deal with consumer goods. So regardless of, the state of the economy, whether things are good or they're bad, people always need to buy their products. So examples could be Tesco, it could be Unilever, Johnson's, brands whereby people always need their stuff regardless of what is going on. And 3rd, if your goal is to see capital appreciation, then you basically want to invest in companies whereby you sort of foresee them doing quite well in the future, so you kind of see some rapid growth happening at some stage. It's best to invest in these companies in their earlier growth years just to give it that time to really develop and grow, and also to see the most benefit. So after you've identified your goals, the next thing that you can do is pick an industry of interest and then identify the top performing companies within that industry. So Apple is a great example because, it's a top performing company within the tech and also consumer goods industries. The next thing that you want to do is diversify your portfolio. So you want to also pick stocks that sort of achieve different goals. Again, you're sort of managing your risk well. And so if you pick a few stocks that give you dividends, so, regular income, and then also pick some for capital appreciation, I feel that strikes a good balance, as well as that buying different stocks in different industries. So not just sticking even in tech, because although we know that tech does really well, it's still also good to diversify and buy in different industries just as that sort of backup. The next thing that you want to do when picking individual stocks, and something that is also very, very key, is basically to keep up with, like, you know, news, trends, you know, what's going on in the market and things that are going to affect your stock in that company. A good example of this is actually Oatly. So recently they had a court case against another company called Pure OT, and they were trying to sue them basically because they were saying how, you know, Pure OT were trying to copy them and, you know, copy their branding and things like that, which Pure OT said, no, actually, you know, we haven't. Like, our branding is completely like two different things. But yeah, essentially this went quite badly for Oatly because a lot of people actually started saying how, you know, they're going to stop buying from Oatly because they felt that what they were trying to do to the smaller company, which is Pure OT, was unfair and they didn't like it, and etc. And, you know, even if you look at the trend and growth of the company, you'll notice that the stock price actually dropped at the point when all of that was going on. Even now, if you look at, you know, Oatly, it's not seen the growth that it was seeing. It's actually plunged, and I think it's remained down because of that incident. So yeah, that's a really good example actually of basically how keeping up with news can help you to identify good stocks, or maybe stocks that maybe you shouldn't invest in. And finally, in picking individual stocks, you want to be looking at a company's like balance sheet essentially. So looking at, you know, what they're making in profit versus their debts. Like, this is a good way to identify a company's position and whether their growth is sustainable or not. Right guys, so that is it from me. That is by no means an exhaustive list. There's loads more that you could look into when investing in the stock market, but I feel that that is a really good start to have. Like, I've covered all the things that you need to consider and have in place as you're starting your stocks investment journey. So I hope you found the video really useful. If you have done, please do give it a thumbs up, and please do also let me know if there are any other sort of like topics that you'd like me to cover, whether it's, you know, investments in the stock market or, you know, property or anything else. Please do let me know and I'll go back creating that video for you. So thank you for watching, and also please do remember to subscribe to my channel if you haven't done so already. So yeah, I'll catch you in my next one. Bye.